Welcome, deep divers. Have you ever looked at the financial markets and felt, well, a bit like you're staring into this swirling, unpredictable vortex, making decisions based on whispers and gut feelings?
Oh, definitely. It's a really common experience.
Yeah, that feeling that trading is maybe more akin to a gamble than, a science. But what if there was a way to truly bring structure, some statistical rigor, and a quantifiable edge to your market approach?
And that's precisely our core mission today. We're here to guide you,
Yeah.
whether you're an aspiring trader, maybe an experienced investor, or just someone looking for more consistency.
Right.
Guide you from that reactive, often emotional approach towards one that is proactive, uh, evidence-based, and really built on solid data.
Hmm.
It's all about cultivating consistency,
Yeah.
systematically managing risk, and, well, moving towards predictable, repeatable outcomes.
And what a journey we have planned for you. This deep dive is custom tailored. We've meticulously abstracted the most impactful, actionable insights from the data-driven trading and investment course materials you've provided us.
Yeah, it's packed with good stuff.
Absolutely. Our goal is to equip you with both the mindset and the practical tools to approach markets with, let's say, unwavering discipline. We'll show you how these powerful principles apply across the entire spectrum, from navigating those short-term trading opportunities right through to making robust long-term investment decisions.
Exactly. And maybe to give you a quick roadmap for the next 20 to 30 minutes or so, we're going to explore that fundamental shift required in your thinking. Delve into the essential tools and data sources that form your analytical workbench.
Your toolkit.
Your toolkit, yeah. And then systematically walk through developing and, crucially, rigorously validating robust strategies. We'll spend significant time on the absolute paramount importance of risk management. Can't stress that enough.
No kidding.
We'll illustrate diverse strategy types with some concrete examples. And finally, chart the path from meticulous tracking to continuous compounding improvement. And, here's a sobering statistic that really underscores why this is so necessary.
Yeah.
Extensive research suggests that over 80% of discretionary traders, those relying mainly on intuition, fail within their first 2 years.
Wow. 80%.
That statistic alone just highlights the incredible leverage a data-driven approach can provide. It's a game changer.
Okay, let's dive right into that core problem many traders face then. We've all had those moments, right, where a trade just felt right or we had a hunch about a market move. But relying on that gut feeling, well, it often leads to a bumpy, inconsistent ride. What are some of the most common, maybe the most damaging pitfalls you see with this intuition-based approach?
Well, the primary issue with purely intuition-based trading is its inherent inconsistency. That and the near impossibility of systematic improvement.
Right, how do you improve if you don't know what worked?
Exactly. When decisions are made based on feelings, they become subjective, they fluctuate with your emotional state, market noise, even personal stress levels outside of trading. This makes it incredibly difficult to apply any kind of strategy consistently or to objectively measure what's actually working and what isn't. Results often get chalked up to sheer luck, good or bad, rather than skill or a repeatable process.
Which means you can't learn from it.
Precisely. It effectively blocks any meaningful learning or refinement. And like you just mentioned, the research, including studies from places like the National Bureau of Economic Research, consistently shows that a vast majority of discretionary traders really struggle to achieve consistent profitability over the long term. This inability to scale success or replicate consistent performance is a critical, often career-ending limitation.
That 80% failure rate is just stark. So if relying on intuition is a path fraught with such high risk, what does data-driven trading offer as a direct, robust alternative?
Well, the contrast is pretty profound, actually. Data-driven trading shifts your decision-making from those subjective feelings to objective statistical evidence.
From feel to fact.
Exactly. That translates into a consistent application of clearly defined, well-tested rules. And because these rules are objective, they provide clear, quantifiable performance metrics. This allows for, let's say, dispassionate evaluation and systematic improvement through iteration. What's truly transformative here is it's about shifting your mindset. You stop asking, what do I feel the market will do? And start asking, what does the data tell me the market has historically done under these specific conditions? And what are the probabilities suggesting now?
That makes sense.
And this approach significantly reduces the destructive impact of common cognitive biases. Things like confirmation bias, where we just seek out info that confirms what we already believe.
Yeah, I'll do that.
Oh, absolutely. Or overconfidence, which often leads to taking way too much risk. Both are rampant in purely discretionary trading.
I can absolutely see how that would be a game changer for many listeners. Just imagine a system, a framework that helps to actively diminish the influence of powerful emotions like fear and greed from your trading process.
It's huge.
Think about that for a moment. No more impulsive buys because you're afraid of missing out, right? FOMO. No more panic sells because of a sudden temporary dip. Instead, you have a quantifiable edge, a statistical advantage that genuinely outperforms random chance, and it's proven through rigorous testing. That ultimately is the bedrock of consistency. And consistency is the hallmark of every truly successful market participant. It allows you to attribute results to your process, not just luck, making your trading scalable, teachable, and most importantly, repeatable.
And the beauty of this methodology, this way of thinking, is its broad applicability. It works across the whole spectrum of market engagement. For aspiring traders, it's absolutely crucial for building proper foundations right from day one. It prevents developing those common detrimental habits that plague so many new entrants.
Starting off on the right foot.
Exactly. Struggling traders can use this framework to precisely pinpoint weaknesses in their current approach. Maybe it's poor execution, misaligned strategies, or unchecked emotional responses.
Yeah.
And even experienced traders can significantly benefit. They can use these techniques to further optimize their existing strategies, quantify their edge more precisely, and potentially automate aspects of their trading for greater efficiency and, frankly, reduced emotional fatigue.
So this isn't just about rapid-fire active trading, then. It sounds broader.
There's not at all. Critically, these principles, data analysis, systematic decision-making, meticulous risk management, they are equally vital for longer-term investment approaches.
Ah, okay.
Whether you're selecting individual stocks for a retirement portfolio or allocating assets across different classes for a large fund, maybe even making real estate investment decisions. The core framework of using evidence-based analysis in a predefined process provides a significant, enduring advantage.
Got it.
So this deep dive isn't really for those chasing get-rich-quick fantasies. Let's be clear about that.
Right, no magic bullets here.
No, it's for those committed to discipline, patience, and continuous evidence-based learning. It's really a marathon of compounding knowledge and controlled execution, not some kind of reckless sprint.
That makes perfect sense. So with this new mindset firmly in place, let's talk about actually getting started. You might be picturing some, complex setup with banks of monitors and super expensive software.
Yeah, the Hollywood version.
Exactly. But thankfully, the initial steps are much more accessible. Think of it like building your data-driven trading workbench. What are the absolutely essential tools for any trader or investor looking to adopt this approach?
You're right. The barrier to entry for the basic toolkit is actually quite low these days. First off, a reliable charting platform is, well, non-negotiable.
Gotta see the charts.
You do. Tools like TradingView or MT4, MT5, that's MetaTrader 4 or 5, are excellent choices. And even their free or basic versions offer really robust functionalities to get you started. Next, you'll absolutely need spreadsheet software. Microsoft Excel or Google Sheets are perfect. These aren't just for, organizing data. They're essential for conducting your own analyses, meticulously tracking your trades, and managing your financial records. We actually provide a comprehensive journal template in the course material specifically designed for this.
Oh, that's handy.
Yeah. Then, a demo trading account with your chosen broker is absolutely crucial. Cannot stress this enough. It allows you to practice, test strategies, make mistakes, and you will make mistakes all without any financial risk.
Practice makes perfect, or at least less costly.
Exactly. And finally, a position size calculator. This is a fundamental tool for proper risk management. It ensures you never risk more than you intend on any single trade. Simple, but vital.
Okay, that's the starter kit. What about for those who eventually want to deepen their capabilities or maybe even automate parts of their strategy down the line?
Right. For more rigorous testing and advanced application, there are optional, more sophisticated tools. Backtesting software, for instance, like Soft4FX, or even the advanced features within platforms like TradingView's premium tiers, allow for much deeper, more comprehensive strategy validation.
Going beyond basic charts.
Exactly. If you want to create your own custom indicators or even fully automated trading systems, bots, or EAs as they're often called, then programming skills become invaluable. Languages like PineScript, which is specific to TradingView, or MQL for MetaTrader are the main ones there.
Okay.
And for those fully automated strategies that need to run continuously, 247 without your personal computer being on, a virtual private server, or VPS, ensures your systems operate without interruption, providing reliability and execution speed.
Fascinating options there. Now, you mentioned your trading decisions are only as robust as the information you base them on. Where does this crucial insight begin? What types of data sources should we really be looking at?
Data truly is the lifeblood, isn't it? Understanding its different forms is key. The absolute foundation is price data, the historical and real-time bid-ask prices you see scrolling on your charts.
The basics.
The absolute basics. You get this from your broker, free sources like Yahoo Finance or TradingView, or for institutional-grade quality professional data providers like Refinitiv or Bloomberg.
Right.
Beyond just price, economic indicators are critical for understanding the fundamental landscape. These include things like GDP figures, employment reports, inflation rates, central bank interest rate decisions.
This is big macro stuff.
Exactly. Sources like Trading Economics or official government statistical offices provide these vital releases. Then we have market sentiment data. This gives you a pulse on the collective mood, the psychology of market participants.
How's everyone feeling?
Pretty much. This might include the commitment of traders or COT reports, put-call ratios, volatility indices like the VIX, and positioning data you can sometimes get from major brokers. And finally, there's this rapidly growing field of alternative data. This is really interesting stuff.
Oh, yeah. Like what?
Non-traditional sources. Things like analyzing social media sentiment, using satellite imagery to track economic activity, or even analyzing anonymized credit card spending data. These can provide unique, cutting-edge insights that maybe aren't fully priced into the market yet, offering a potential edge.
Wow.
But the crucial step with all data is always evaluate its quality, combine multiple sources for a holistic view, and critically, avoid common interpretation pitfalls like just reacting to headlines without any deeper analysis.
That's a really comprehensive overview. Now, markets aren't monolithic, right? Each has its own personality, its own rhythm, and understanding that seems vital. Let's talk about two popular markets many listeners might be interested in, Forex and gold. What makes them unique, and how does that uniqueness impact a data-driven strategy?
That's a great point. The market itself often dictates how you should approach it. Take Forex, the foreign exchange market. It's genuinely a 24-hour market, trading continuously from Sunday evening right through Friday afternoon. That offers incredible flexibility.
Always open somewhere.
Pretty much. Its sheer liquidity is staggering, over $6.6 trillion traded daily. It's the largest financial market globally. This high liquidity generally means tighter spreads the cost of trading and often allows for higher leverage than in other markets. Currency pairs exhibit these complex correlations, driven by big macroeconomic factors like interest rate differentials between countries, geopolitical events, things like that. And due to the high volume of algorithmic trading in these fundamental drivers, Forex markets generally show strong responsiveness to technical levels, making them a really fertile ground for systematic strategies.
Okay, it makes sense for Forex. What about gold, XAUUSD?
Right, gold. Gold has this long-standing role as a safe haven asset. Investors tend to flock to it during periods of economic or political uncertainty when other assets look risky.
Flight to safety.
Exactly. It's also historically served as an inflation hedge, tending to maintain its value when fiat currencies, like the dollar, decline. You'll often observe an inverse relationship with U.S. dollar strength. As the dollar gets stronger, gold tends to weaken, and vice versa.
Interesting relationship there.
Yeah, and gold possesses this dual nature. It functions both as a commodity, used in jewelry and industry, and as a monetary asset held by central banks. From a technical perspective, gold often shows remarkable respect for historical support and resistance levels, and also Fibonacci retracement levels, making technical analysis a powerful component of its data-driven strategies. So understanding these unique characteristics for each market is essential for applying data-driven methods appropriately and tailoring your strategies for optimal, context-aware results.
I can definitely see how that market context is crucial. So, to bring this all together, let's just reinforce the core principle here. Systematic thinking. It's not about removing you, the trader, from the equation entirely, is it? It's more about giving your brain a much-needed break from that constant high-pressure, moment-to-moment decision-making.
Precisely. A systematic approach dramatically reduces cognitive load. You're no longer reinventing your process with every single trade, grappling with uncertainty. Instead, you're executing a predefined, tested plan.
Takes the pressure off.
It really does. This allows for truly measurable performance, creating a continuous feedback loop for enhancement. You can identify what works, what doesn't, and refine your approach with precision. And crucially, it provides profound psychological protection.
The mental side.
Hugely important. These systems act as essential guardrails against common pitfalls. like revenge trading, trying to immediately win back a loss, or overtrading, just chasing the market action. It also fortifies your adherence to a proven strategy during those inevitable drawdowns, preventing you from emotionally abandoning it just when it might be about to turn around.
Right when it's about to work again.
Exactly. Carly Fiorina once wisely stated, "The goal is to turn data into information and information into insight." And research, including studies from institutions like the University of Cambridge, consistently suggests that systematic traders demonstrate significantly more consistent results and, interestingly, lower stress levels, particularly during high volatility market periods. This is about building a robust psychological framework just as much as a statistical one.
That's a really powerful shift in perspective. Now that we've talked about the why and the essential what, let's get a bit personal. Before you even think about specific strategies or indicators, you need a clear North Star for your journey, right? You need clear, realistic objectives. It's like knowing your destination before you even start the engine.
That's absolutely fundamental. Your trading goals must be meticulously defined. We strongly advocate using the SMART criteria. Your goals should be specific, for example, generate an average of 15% annual returns, not just vaguely make money trading.
Right, be precise.
Precisely. They must be measurable with quantifiable metrics, allowing you to track progress objectively. They need to be achievable, and this is where many new traders falter, setting wildly unrealistic expectations like double my account every single month.
Yeah, that sounds unlikely.
Extremely. For context, even top professional hedge funds typically target a compound annual growth rate, or EGAGR, of maybe 10–20% for their returns, consistently. Your goals must be relevant to your personal financial needs and lifestyle, and critically, time-bound with clear milestones for evaluation. And it's also vital to align these goals with your personal risk tolerance, the actual time you can realistically dedicate, and your psychological temperament, because different trading styles really do suit different personalities. This alignment is absolutely key to long-term sustainability.
We've been using the terms trading and investing a bit interchangeably at times. And while this deep dive focuses primarily on active trading techniques, you mentioned these data-driven principles apply to both. Could you just quickly clarify the distinction for everyone?
Certainly. While the analytical framework is versatile, the application does differ. Trading generally involves shorter time frames, anywhere from minutes up to maybe weeks, with a heavy focus on price action and technical analysis.
Patterns, indicators.
Exactly. It's characterized by a higher frequency of transactions, often utilizes leverage to amplify potential returns, of course risks, and aims to profit from both rising and falling markets. Trading requires active management and monitoring, and success is measured by consistent risk-adjusted returns. Investing, on the other hand, involves significantly longer time frames, think months to years, even decades, with a greater emphasis on fundamental analysis, looking at companies, sectors, broader economies.
The underlying value.
Precisely. It has a much lower transaction frequency, typically uses little or no leverage, and traditionally focuses on capturing upside appreciation or long-term dividends. Investing can be more passive, with maybe periodic rebalancing, and its success is measured more by total wealth accumulation over time.
Got it.
It's worth noting, though, that many successful market participants actually combine both approaches. And the data-driven framework we're discussing is definitely adaptable to both, though the specific techniques and tools will naturally differ.
Okay, that's clear. So you've defined your goals, you understand the trading versus investing distinction. Now, let's talk about how you actually execute your decisions within those parameters. Time frames and styles. How do you find the fit that's right for you, your lifestyle, and maybe your personality?
Yeah, this is where your personal lifestyle, your available capital, and your psychological makeup really come into play. It has to fit you. There are three main trading styles, broadly speaking, each with distinct characteristics. First is day trading.
The fast one.
The fast one, yeah. Holding positions only within a single trading day, never overnight. You're typically using very short time frames, like 1 minute up to maybe 1 hour charts. It's high frequency, requires a significant time commitment, often full-time dedication, and typically aims for smaller profits per trade, but with a higher volume. You might aim for a 50–60% win rate. It's best suited for full-time traders who can dedicate several hours a day to active monitoring. Next up is swing trading. This involves holding positions for a few days, up to maybe a couple of weeks. You're typically using 1 hour to daily charts. It has a moderate trade frequency, making it much more suitable for part-time commitment, maybe an hour or two a day, for analysis and trade management.
More manageable for many.
Much more. Profits per trade are moderate, with typical win rates ranging from 40–55%. This style is often ideal for busy professionals or part-time traders.
Right.
And finally, there's position trading. This involves holding positions for weeks to several months, sometimes even longer. You're utilizing daily, weekly, even monthly charts. It has a low trade frequency and requires minimal time commitment, often just checking in once a day or even just a few times a week.
The long game.
The long game. It aims for larger profit per trade, but typically with a lower win rate, maybe 35–45%. This is often the best fit for busy professionals or those with larger capital who don't need frequent compounding. The crucial point is your choice should fundamentally align with your lifestyle, capital constraints, and psychological temperament. Trying to force a style that doesn't fit you is just a recipe for frustration and, ultimately, failure.
That makes sense. Find your lane.
Exactly. And many successful traders actually start with longer time frames and gradually incorporate shorter ones as they gain experience and confidence. It's not set in stone.
Okay.
Now, with these choices in mind, it's incredibly valuable to build a personal trading mission statement.
A mission statement. Like for a company?
Sort of, yeah. But for you. Yeah. It defines your purpose and core principles. It acts as your compass and your anchor, especially during those inevitable, difficult market periods. It helps maintain consistency when emotions are running high.
Interesting. What goes into it?
Your mission should address your purpose. Why are you trading beyond just making money? Maybe it's financial freedom, intellectual challenge, providing for family. It defines your values principles like discipline, patience, continuous learning, your boundaries in self, what risks you will and won't take, or what markets or setups you'll avoid, your identity, how do you see yourself, a disciplined trend follower, a contrarian, a systematic mean reversion specialist, and finally, your contribution. How does trading fit into your broader life goals?
Wow, that's quite deep.
It is. What's truly profound here is that every serious trader needs a mission statement. It provides clarity during confusion and unwavering guidance during uncertainty. And it's not a static document, it's a living guide. Make sure you revisit it regularly as you grow and evolve in your trading journey.
That's a powerful idea. It really sounds like it's not just about the numbers, but about defining your purpose and how you operate within the market. So, once we've established our goals, our preferred style, maybe even grafted a mission statement, what does true success actually look like in this data-driven world? It's clearly not just about hitting home runs, is it?
Absolutely not. That's a common misconception. True success in data-driven trading is defined by a combination of key performance metrics, which paint a holistic picture that goes way beyond just raw profit. Your win rate, the percentage of profitable trades, is often quite modest for successful traders.
Yeah.
45% is common for many robust strategies.
Only 45%. That surprises some people.
It does. But what truly matters is its relationship with your reward-to-risk ratio. Your profit factor, calculated as total profit divided by total loss, should ideally be above 1.5. Anything above 2.0 is considered excellent, indicating your winning trades are significantly larger than your losing ones. Maximum drawdown, the largest peak-to-trough decline in your account value during a losing streak, should ideally be kept below 15% for conservative traders. Professionals often aim for under 20%. Keeping this manageable is crucial psychologically.
Right, surviving the dips.
Exactly. And finally, the Sharpe ratio, a key measure of risk-adjusted return. It tells you how much return you're getting for the risk you're taking. It should ideally be above 0.5 to be acceptable, and above 1.0 is considered excellent. So success isn't just about how much money you make. It's about achieving consistent, risk-adjusted returns and maintaining psychological stability over the long haul. It's about making trading a sustainable, reliable part of your financial life, not a source of constant stress and wild emotional swings.
All right, now we get to the real meat of it. How do we actually build and validate a robust trading strategy? You mentioned a workflow. Think of this data-driven workflow as a kind of scientific method specifically tailored for your trading. It sounds like a systematic, repeatable process designed to eliminate guesswork.
That's a perfect analogy. This 8-step workflow is essentially your roadmap to developing and refining strategies that actually work and, crucially, that persist over time. Doesn't happen overnight.
Okay, step one.
Step 1 is market analysis. This is where you meticulously examine historical data charts, price movements, maybe volume, to identify recurring patterns, behaviors, or potential inefficiencies in the market you're interested in.
Looking for clues.
Looking for clues, exactly. From there, you move to hypothesis formation. You create a clear, testable statement about a specific market behavior you think you've observed. For example, the USD currency pair tends to revert back to its 20-day simple moving average after reaching 2 standard deviations away, especially when supported by a momentum divergence on the RSI. It has to be specific.
Testable is key.
Absolutely.
Yeah.
The third step is strategy development. This is where you translate that hypothesis into a precise, objective set of rules for entry, exit, position sizing, and risk management. Every single aspect must be quantifiable, unambiguous.
No room for maybe.
None. Once your rules are clearly defined, you perform backtesting. You run your strategy against historical data to assess its past performance without risking any actual money. This leads into step 5, optimization, where you carefully refine strategy parameters like the length of a moving average or an RSI level to improve performance. But you have to do this very carefully, always watching out for a common pitfall called curve fitting, which we'll definitely talk more about.
Okay, important caveat there.
Very. Then comes forward testing, sometimes called paper trading. This involves testing the optimized strategy in real time on a demo account, verifying that it performs as expected in live, evolving market conditions, not just historical data.
Reality check.
Exactly. If that looks good, you move to gradual implementation, deploying the strategy with real capital, but scaling your exposure slowly, starting small. And finally, step 8, it's about monitoring and refinement. This is ongoing, continuously tracking live performance and making necessary data-backed adjustments as market conditions inevitably evolve over time. This entire cycle is iterative, it's continuous improvement.
Okay, that's a really solid, structured process. So we've got this detailed workflow, but what truly distinguishes a good, robust strategy from maybe just a lucky streak you found in testing? How do we know it's not just a fluke that worked in the past?
That's a critical question. A truly robust strategy possesses 5 essential characteristics. First, it must demonstrate a clear statistical edge, a quantifiable, persistent advantage that allows it to outperform random chance across various market conditions over time.
It actually has to work.
Fundamentally, yes. Second, robustness is key. This means its performance remains reasonably consistent across different market conditions, trending, ranging, different but related instruments like maybe other currency pairs and different time periods without requiring constant reactive adjustments.
Adaptable.
Exactly. Third, clarity and objectivity are paramount. The rules for entry, exit, risk management, everything must be crystal clear, leaving minimal room for subjective interpretation or emotional influence during execution.
Easy to follow under pressure.
Precisely. Fourth, and this is often underestimated, psychological compatibility. This is absolutely vital. Even a statistically profitable strategy will ultimately fail if you personally cannot consistently execute it because it doesn't align with your risk tolerance, your available time, or your emotional temperament.
If you can't stick with it, it doesn't matter how good it is on paper.
100%. And finally, ideally, it should have a logical premise. It should be based on a reasonable market inefficiency or a recurring behavioral pattern that has some kind of logical explanation for why it might exist and persist. It's really the combination of all these factors that creates a truly enduring strategy.
Before we even layer on indicators and fancy tools, let's establish the foundational language of the market itself. Price action and structure. What are these fundamentals and why are they so crucial, even in a data-driven approach?
Price action is, quite literally, the raw, unfiltered movement of price over time, as displayed on your charts. It's the story of supply and demand playing out in real time. Key concepts within price action include support and resistance. These are price levels where buying or selling pressure has historically been strong enough to halt or reverse price movement, acting as potential turning points.
Ceilings and ceilings.
Good analogy. We also analyze trend structure, identifying the characteristic patterns of higher highs and higher lows that define an uptrend, or lower highs and lower lows for a downtrend. Candlestick patterns, those little bars on the chart, provide a visual representation of price movement within a specific time frame, often signaling shifts in market sentiment or potential reversals.
Like dojis or engulfing patterns.
Yeah, exactly. Then you have broader chart patterns, like head, shoulders, triangles, flags, wedges. These develop over multiple price bars and can suggest future price direction based on historical tendencies. Understanding market swing points, the significant peaks and troughs in price, helps define the market's current structure and identify potential areas where trends might change. And finally, things like order flow, which you can sometimes infer from the speed and aggressiveness of price movement along with volume, tell us about the underlying buying and selling pressure driving the moves.
So why is this so foundational?
Because price action analysis reflects the actual decisions of market participants, where they're buying, selling, taking profits, placing stops. It's the most direct reflection of market psychology, making it an incredibly powerful and often leading input for data-driven strategies, even before you add any derived indicators.
Okay, now onto the tools. There are literally hundreds, maybe thousands of indicators out there, and it can be really overwhelming, especially for new traders. So, how do we approach this intelligently? It sounds like it's about smart, synergistic tool selection, not just collecting every shiny new object you encounter. Which indicators truly matter, and how do we use them effectively in a data-driven way?
You're absolutely right. It's definitely about mastering a few complementary tools rather than superficially collecting many. The real power comes from how you interpret and apply them within a cohesive, logical framework. Let's maybe focus on two absolute workhorses that are very common and effective. First, the exponential moving average, or EA.
Email. Okay.
It smooths out price data, but gives more weight to recent prices compared to a simple moving average. This makes it excellent for identifying the current trend direction and often acting as dynamic support or resistance as price moves. Think of it as reflecting the market's current trajectory or average consensus price over a specific period. Common setting traders use are the 8, 21, 50, and 200 period EMAs.
So it tells you the direction.
Primarily, yes. But a trajectory alone doesn't tell us if that movement is becoming overstretched or maybe losing steam. That's where an indicator like the Relative Strength Index, or RSI, comes in.
RSI, I've heard of that one.
Very popular. The RSI is a momentum oscillator. It measures the speed and change of price movements, oscillating between 0 and 100. It helps identify potentially overbought conditions. Maybe price has gone up too far, too fast, and might be due for pullback, usually above 70. Or oversold conditions, price might have fallen too far, too fast, and could be due for a bounce, usually below 30.
Okay.
And crucially, the RSI can show divergences with price. For example, if price makes a new high, but the RSI fails to make a new high, that's a bearish divergence, often signaling underlying weakness and a potential reversal. A standard setting for RSI is 14 periods.
Trend and momentum, that sounds like a good combo.
It is. If we were to add a third key one, the Moving Average Convergence Divergence, or MACD, is another powerful trend-following momentum indicator. It generates trading signals through the crossover of its two lines, the MACD line and the signal line, and also by looking at changes in this histogram, which shows the distance between these two lines. This can help confirm trend strength or signal potential weakness. Standard settings are typically 12, 26, and 9 periods.
Okay. EMA, RSI, MACD. Got it.
The real emphasis, though, is on rigorously testing their individual effectiveness on the markets and timeframes you trade, objectively optimizing their parameters using your own data, and most importantly, combining them intelligently to create robust confirming signals while actively avoiding redundancy. You definitely don't need 5 different oscillators all telling you basically the same thing. That just creates false confidence. For instance, combining an EMA for trend direction with an RSI for entry timing or diversion signals can create a powerful confluence.
Speaking of combining things, let's talk about multi-timeframe analysis, or MTA. You hear this mentioned a lot. It sounds like a powerful technique because it's sort of like zooming in and out on a map, seeing both the immediate surroundings and the broader landscape. What are its core principles, and how does it give traders a sharper edge?
MTA is indeed a cornerstone technique for gaining a comprehensive understanding of market context and significantly improving the quality and probability of your trades. Its principles are based on a clear hierarchical structure. Higher time frames, like the daily or weekly charts, set the primary trend, the overall context, and identify the major significant support and resistance levels.
The big picture.
The big picture, exactly. Lower time frames, like a 4-hour or 1-hour chart, are then used for identifying more precise entry and exit points within that broader directional bias established by the higher time frames.
Aligning the signals.
Precisely. This allows for powerful confluence, where signals aligning across multiple time frames have significantly greater reliability and probability of success. If the daily chart shows an uptrend and the 4-hour chart gives a buy signal during a pullback, that's much stronger than a 4-hour buy signal when the daily trend is down.
Okay.
It's also excellent for filtering out noise. Higher time frames naturally filter out the minor, often random fluctuations and false signals that are common on lower time frames. This helps ensure your trades align with the dominant, more powerful market current, not just short-term blips.
What's a common approach?
A common, effective approach uses 3 time frames with a roughly 4.1 or 5.1 ratio between them. For example, using the daily chart to identify the overarching trend direction and key levels, then using the 4-hour chart as your primary trading time frame for identifying potential setups, and finally using the 1-hour chart for timing your precise entry and refining your stop-loss placement.
Daily, 4-hour, 1-hour.
But it's crucial not to give equal weight to all time frames. The higher time frame always takes precedence in defining the overall market bias. You generally want to trade in the direction of the higher time frame trend. MTA has been consistently shown to significantly improve win rates and risk-reward ratios by ensuring you're trading with the prevailing market current, not fighting it.
All right, this is great. So let's say you've observed a potential pattern in the market. You've got your analytical tools like EMAs and RSI ready, and you understand the multi-time frame context from MTA. How do you actually build a specific, actionable strategy from scratch? It sounds like it's partly an art spotting those initial patterns, but also very much a science rigorously testing them.
It absolutely is both, and it's a really rewarding process when you get into it. It starts with market observation. This means spending dedicated time studying historical charts and data, just looking for recurring patterns, potential inefficiencies, or particular behaviors in the instrument or market you're interested in. You're essentially pattern hunting.
Being a market detective.
Exactly. This naturally leads to hypothesis formulation. Based on your observations, you create a clear, specific, and testable statement about that behavior. For instance, gold tends to rebound significantly off the 200-day EMA after falling for 3 consecutive days with decreasing volume, indicating potential exhaustion of selling pressure. See how specific that is?
Very clear, yeah.
Then you move to meticulous rule definition. This is where you transform that hypothesis into a specific, objective, and quantifiable set of rules covering every aspect. Precise entry conditions, clear exit rules, both for profit and loss, your position sizing model, and overall risk management parameters. Every single step must be clear enough that theoretically a computer could execute it without ambiguity.
No wiggle room.
No wiggle room. After defining the rules, you conduct some initial testing. This often involves manually reviewing historical charts over a significant period, applying your rules, and calculating rough performance metrics like win rate and average RR. This gives you a first quick glance at whether the idea has potential or if it needs major rethinking.
A quick sanity check.
Exactly. Finally, there's a continuous refinement cycle. Based on your initial testing and subsequent backtesting results, you adjust and tighten your rules for better clarity, objectivity, and hopefully improved effectiveness, always being mindful of that curve-fitting danger. So what does this all mean for you? Strategy development is indeed an art, having the eye to spot those potentially profitable patterns, but it's underpinned by an essential science, rigorously testing and validating them with hard data to ensure they hold a true statistical edge over time. Both aspects are absolutely essential for creating robust, durable strategies that can stand the test of time. Okay, once you've meticulously built your strategy, the next critical step, definitely before risking any real capital, is to test it rigorously. This isn't where you just jump in and hope for the best. We're talking about back testing, essentially your chance to see the future by looking carefully at the past. Back testing is precisely that. Simulating how your trading strategy would have performed on historical market data. It's absolutely essential, non-negotiable really, because it allows you to validate your strategy's potential effectiveness and quantify its expected performance metrics, things like win rate, profit factor, maximum drawdown, all without putting any actual financial capital at risk.
See if it even worked historically.
Exactly. It helps you identify potential weaknesses in your logic or rules, builds crucial confidence in your system before you trade it live, and allows you to objectively optimize parameters. You can backtest manually, just scrolling through charts, which is incredibly valuable for truly understanding market mechanics and how your rules interact with price.
Learning the ropes.
Definitely.
Yeah.
Or you can do it semi-automatically using platform features like TradingView's replay mode, which steps through historical data bar by bar. Or you can go fully automated with specialized software, or by programming your strategy in languages like PineScript or MQL.
Lots of options.
Yeah, but crucially, you have to be intensely aware of common pitfalls in backtesting. One is look-ahead bias, where your testing accidentally incorporates information that wouldn't have been available at the time of the simulated trade. Very easy mistake to make.
Using future data, basically.
Exactly. Another is survivorship bias, which means testing only on instruments or stocks that still exist today or have performed well, inadvertently ignoring those that failed or were delisted. This can dramatically inflate your results.
Skews the data.
Big time. And perhaps most importantly, assuming perfect execution. Real-world trading involves things like slippage, the difference between the price you expected and the price you actually got filled at, especially in fast markets, and commissions or fees, which backtests often ignore but definitely impact profitability. You need to account for these realities.
Okay, so backtesting is crucial, but with caveats. Now, building on that, you mentioned an even more advanced technique that takes backtesting a step further, making the results potentially even more robust, Walk-forward testing. What's that about?
Yes, walk-forward testing is generally considered a more accurate simulation of how a strategy would truly perform in live trading because it accounts for the natural evolution and optimization process a real trader would undertake over time.
Simulating real life more closely.
Precisely. What's truly fascinating here is that it simulates how a trader would genuinely adapt and optimize their strategy as market conditions change. The process involves first optimizing your strategy parameters on an in-sample period of historical data, let's say 2 years of data.
Okay.
Then you take those optimized parameters and test the strategy without any further changes on a subsequent, previously unseen out-of-sample period, maybe the next 6 months of data. You record the performance.
Testing on unseen data.
Crucial step. Then you slide both windows forward, maybe drop the oldest 6 months and add the newest 6 months, and repeat the process. Re-optimize on the new in-sample period, then test on the next out-of-sample period. You keep doing this, walking forward through your historical data.
I see, like steps.
Exactly. A truly robust strategy will show reasonably similar performance characteristics across all those different out-of-sample periods, indicating its underlying edge persists and isn't just a fluke of one specific historical period. There's even a metric called walk-forward efficiency, WFE. A WFE above, say, 70% generally indicates a robust strategy that isn't overfitted, meaning it's much more likely to perform well in future unseen market conditions.
Now, there's a lurking danger in all this rigorous testing and optimization, something that can completely derail an otherwise promising strategy. It's a really critical concept, the curve fitting trap. And here's where it gets really interesting and often kind of counterintuitive. The enemy of a truly robust, long-lasting strategy isn't necessarily a losing trade. Sometimes it's a perfectly performing backtest.
That's a profound truth, and honestly, it's a trap that so many aspiring quants and traders fall into. Curve fitting, or overfitting, as it's also known, occurs when a strategy is excessively optimized. Too many rules, too many filters, parameters tweaked just so to perform exceptionally well on a specific set of historical data.
Tailored too perfectly to the past.
Exactly. It ends up capturing random noise or unique historical anomalies rather than genuine, enduring market patterns. This leads to these spectacular, unbelievable backtest results that then completely fall apart, just utterly fail, when the strategy is deployed in live trading because the underlying noise it was fitted to doesn't repeat.
So how do you spot it?
There are warning signs. Strategies with a huge number of parameters or rules are suspect. Extreme sensitivity, where tiny changes in parameters cause massive swings in backtest results. Suspiciously perfect backtests with incredibly smooth, almost straight-line equity curves. Real trading is never that smooth. And rules that are overly complex or seem illogical, lacking a clear market rationale.
Okay. And how do you prevent it?
Prevention is key. You absolutely must use out-of-sample testing and, ideally, walk-forward analysis. Generally, prefer simpler strategies with fewer adjustable parameters. Always test your strategy across multiple, diverse instruments or markets if possible, and across different time periods. And always focus on strategies based on logical, explainable market inefficiencies or behavioral patterns, not just statistical correlations you can't explain. As the course wisely notes, the more complex the strategy and the more parameters optimized, the higher the chance of curve fitting. Simple is robust. Complex is fragile. That's a great mantra.
Simple is robust, complex is fragile.
I like that. Now, when you're evaluating these strategies, whether from backtests or live trading, it's crucial to look beyond just the simple bottom-line profit and loss. You need to track multiple metrics to get a comprehensive view of both the potential reward and the inherent risk and consistency.
What are the key ones?
Key metrics include your win rate. The percentage of profitable trades, remember, 40–60% is often a realistic target, depending heavily on the strategy's RR. The profit factor. Total gross profit divided by total gross loss. You want this well above 1, ideally above 1.5, with over 2.0 being excellent. We also consider expected value or expectancy, the average profit or loss you anticipate per trade, calculated based on win rate and average win-loss size. It must be positive over the long run for a profitable strategy.
Makes sense.
Then there's maximum drawdown. That largest peak-to-trough decline in your account value, keeping this below 20%, preferably lower, is vital for psychological survival. The recovery factor, which is total net profit divided by max drawdown, shows how quickly you recover. Higher is better, above 3 is good. And the Sharpe ratio, that risk-adjusted return measure we mentioned, above 0.5 acceptable, above 1.0 is excellent. Other useful ones include average trade duration and the profit drawdown ratio, which gauges how much profit you generate for every dollar of drawdown experienced.
So it's clear that no single metric tells the whole story. It's really about understanding the combination and how they all interplay to define the strategy's character.
Exactly. It's a dashboard, not a single gauge.
Mm.
And when you do decide to optimize those parameters, you absolutely must do it without falling into that curve-fitting trap we discussed.
How do you do that carefully?
It requires discipline. Use a limited parameter space. Maybe only optimize 2 or 3 key parameters at a time, not dozens. Choose logical parameter ranges and use sensible step sizes during optimization. Don't test every single possible value down to the 5th decimal place. Importantly, consider optimizing for robustness metrics like the Sharpe ratio, which inherently balances risk and return rather than simply chasing the maximum possible historical profit, which is often fragile.
Focus on stability.
Stability and consistency, yes. Always perform rigorous out-of-sample validation and parameter sensitivity analysis check if small changes drastically alter results. It's far, far better to choose parameter settings that sit on broad plateaus of consistently good performance in your optimization reports rather than selecting isolated sharp peaks that might represent overfitting. Stability is far more valuable than maximum historical performance that might never repeat.
Let's try and bring this all to life with a concrete example from the course material. Show us how these testing principles actually come together in practice.
Okay, perfect. We can look at the URISD mean reversion strategy detailed in the course as a clear illustration of this whole process. The underlying hypothesis behind this strategy is that URISD, being a heavily traded liquid currency pair, tends to revert back towards its average price specifically, its 20-day simple moving average, SMA, after significant deviations from that average. This tendency is believed to be especially strong when the deviation is supported by a momentum divergence, signaling the move might be losing steam, and occurs in generally non-trending, ranging market conditions.
So looking for stretched prices to snap back.
Exactly. The entry conditions are very precise. A long entry, a buy, is triggered only when the price falls to at least 1.5 standard deviations below the 20-day SMA. Simultaneously, the Relative Strength Index, RSI, must show a bullish divergence, meaning price is making lower lows, but the RSI indicator is making higher lows, suggesting waning downward momentum. And finally, the Average Directional Index, ADX, a trend strength indicator, must be below 25, indicating a non-trending ranging market is likely in place. A short entry, a sell, would be the exact inverse of these conditions.
Very specific rules. Okay, what about getting out?
The exit rules are equally clear and objective. You take profit if the price successfully reverts back and touches the 20-day SMA. Your stop loss is triggered if the price moved 0.5 standard deviations against your trade direction from the entry point. There's also a maximum holding period of 10 trading days, acting as a time-based exit if neither the profit target nor the stop loss is hit within that time frame.
Okay, clear entry, clear exit. How did it perform in testing?
The backtesting results documented over a 5-year historical period for this specific strategy were quite compelling. It generated 87 total trades. It had a solid 68% win rate, which is quite high for many strategies. A robust 2.3 profit factor, meaning gross profits were 2.3 times gross losses. The average profit per trade was 0.42%. And crucially, it exhibited a very low maximum drawdown of only 4.8%. This combination resulted in an excellent Sharpe ratio of 1.8, indicating strong risk-adjusted returns.
Wow, those are impressive numbers. But what about overfitting? How did the walk-forward test look?
That's the critical question. The walk-forward validation performed on this strategy showed that it maintained 83% of its in-sample performance during the subsequent out-of-sample testing periods. This WFE of 83% is well above the 70% benchmark, providing strong evidence of a robust design without significant overfitting. It really demonstrates the power of combining multiple, logically consistent data points, price deviation, momentum divergence, and trend strength confirmation to create a truly effective and potentially durable trading strategy.
That URISD example really does show the power of that data-driven testing process. But now we absolutely need to talk about something that you've hinted at, something even more critical, arguably. If strategy development is maybe the engine of your trading car, then risk management is undoubtedly the brakes, the steering wheel, and the seatbelt all rolled into one. Without it, you're simply, well, on a joyride heading towards disaster. This feels like the most critical component of consistent, sustainable trading.
You've absolutely hit on the most profound truth in trading. Capital preservation is your first, your middle, and your last priority. It's everything.
Job number one.
Job number one, period. Without capital, you simply cannot trade no matter how brilliant or well back-tested your strategy might seem on paper. Effective risk management is what ensures consistency over time. It smooths out your equity curve, prevents those catastrophic account-ending losses during the inevitable drawdown periods that every strategy, no matter how good, will eventually face.
Yeah.
It also provides profound psychological stability. It significantly reduces emotional stress and allows for clearer, more objective decision-making, even when markets get volatile or you're in a losing streak. The legendary trader Ed Seykota famously quipped, "The elements of good trading are 1. Cutting losses, 2. Cutting losses, and 3. Cutting losses."
He wasn't subtle about it.
Not at all. And this raises an important question for every single trader listening. Why, despite this universal wisdom, is effective risk management so often overlooked, minimized, or compromised, especially when emotions run high? Let me state this unequivocally. A mediocre strategy with excellent risk management will consistently outperform an excellent strategy with poor risk management over the long term. Full stop.
That's a bold statement, but it makes sense. So before you even think about putting a single pound, dollar, or euro on the line, you need to understand yourself deeply. Defining your personal risk tolerance sounds absolutely key here.
It is. Your risk tolerance is the amount of market volatility and, more importantly, potential drawdown you can genuinely withstand, both financially and psychologically, without panicking and abandoning your well-tested trading plan.
How do you figure that out?
It's influenced by your financial situation, clearly. Things like the percentage of your total assets you're allocating to trading, is it 5% or 50%?
Yeah.
Your income dependency, do you need trading profits to pay bills? Your overall financial safety net, your investment time horizon. But just as important, maybe even more so, are the psychological factors.
The mental game again.
Always. We often refer to this using the sleep test.
Yeah.
Can you genuinely sleep soundly at night with your current open positions and the potential maximum loss they represent? How do you really react emotionally during losing periods? Have you historically abandoned strategies during normal, expected drawdowns in the past? Be honest with yourself. What's fascinating here, and we see this all the time, is that most traders tend to significantly overestimate their actual risk tolerance, especially when they're just starting out or things are going well. It's always best to start conservative, perhaps even more conservatively than you initially think you need to. Only consider increasing your risk exposure gradually, and only after you've actually experienced and successfully managed smaller drawdowns with emotional composure and stuck to your plan.
That's great advice. Start small, prove you can handle it. So how do we translate that personal risk tolerance into practical action when we're actually putting money on the line? We're talking about the crucial concept of position sizing, right?
Exactly. Position sizing is arguably your single most effective shield against catastrophic ruin. It's how you control your risk on every single trade. Most widely recommended technique for most data-driven traders is fixed percentage risk.
Okay, how does that work?
With this method, you decide to risk a fixed percentage, typically 1% to 2%, is strongly advised for most traders of your current account balance on each individual trade. The key is current balance. This method automatically adjusts your actual position size, how many shares, contracts, or lots you trade, based on the distance from your entry point to your predetermined stop loss for that specific trade. This maintains a consistent risk exposure in dollar terms across all trades, regardless of the setup's volatility. For example, if you have a 10,000-pound account and decide to risk 1% per trade, that's 100 pounds of risk. If your stop loss for a particular trade setup is 50 pips away on a Forex bear, you then calculate your position size in lots, such that a 50-pip adverse move results in exactly a 100-pound loss.
So the size changes, but the risk stays the same.
Precisely. This means your position size naturally decreases after losses, protecting capital, and increases after gains, compounding growth. Other methods exist, like fixed monetary amount, which is simple but doesn't scale with your account size, or volatility-based sizing, which adjusts size based on market volatility using indicators like the average true range, ATR, to try and normalize risk across different market conditions. There's also the mathematical Kelly criterion for optimal sizing, but it often leads to very aggressive sizing, so often a half Kelly or a fractional Kelly approach is recommended if you explore that. But fixed percentage is usually the best starting point.
Okay, fixed percentage risk, 1-2%. Got it. What about actually setting the stop loss and take profit levels? How do you determine those points?
Right, equally crucial to your financial survival and growth. For stop losses, the ideal balance is finding a level that's tight enough to limit your maximum risk on the trade to your acceptable level, like that 1-2%, but also wide enough to avoid being prematurely stopped out by just normal market noise or minor insignificant fluctuations before your trade idea has a chance to play out.
Don't want to get stopped out too easily.
Exactly. Technical stop losses are generally preferred. These are placed logically beyond significant support or resistance levels or beyond recent swing points, highs or lows. These are points where, if price reaches them, your original trade idea or setup is logically invalidated by the market action itself.
Makes sense.
Volatility-based stops, often using multiples of the average true range, ATR, dynamically adapt the stop distance to current market volatility. Wider stops in volatile markets, tighter stops in quiet markets. For take profits, you might target known major support resistance levels further away, Fibonacci extension levels calculated from previous moves, or simply use a fixed reward, risk ratio target. For example, if your stop loss represents 1R, 1 unit of risk, you might aim for a take profit at 2R or 3R.
Aiming for bigger winners than losers.
That's the goal. You can also use partial take profits, where you exit portions of your position at different predetermined targets, maybe take some off at 1R, some more to 2R, and let the rest run. This can help secure gains and reduce psychological pressure. Importantly, research consistently suggests that technical stop losses based on actual market structure tend to significantly outperform arbitrary fixed distance stops, like always using a 50-pip stop, because they are rooted in actual market behavior and logical invalidation points.
That brings us right to the core of sustainable profitability, the reward-to-risk ratio, or 4R. You've mentioned it a few times. This isn't just a simple calculation. It sounds like it's the very heartbeat of a trading strategy's long-term viability.
It really is fundamental. The reward-to-risk ratio is the precise relationship between the potential profit you aim to achieve, the distance from entry to your take profit, and the maximum potential loss you are willing to incur, the distance from entry to your stop loss, on any given trade. If you risk 50 pips, your stop loss distance, to potentially gain 100 tips, your take profit target, that's a 2.1 RR ratio.
Simple enough. Simple to calculate, yes, but its implication is huge. This ratio is critically linked to your strategy's win rate through the expectancy equation. Expectancy tells you the average amount you can mathematically expect to win or lose per trade over a large number of trades. The basic formula is expected value, win percentage x average win size, loss percentage x average loss size.
Okay.
For a trading system to be profitable in the long run, its expectancy must be positive. Consider the relationship with a 1.1 RR, average win equals average loss. You need a win rate significantly above 50% just to break even after costs. However, with a 2.1 RR, average win is twice the average loss, you only need a win rate above 33% to be profitable. And with a 3.1 RR, a win rate above just 25% can lead to profitability over time.
Wow, that changes the game completely. This is precisely why many professional traders prioritize achieving favorable RR ratios, often 2.1 or higher, and are perfectly comfortable accepting win rates of only 40–50%. They understand that ensuring their average winners are significantly larger than their average losers is the key to long-term success. A common, very dangerous mistake, especially for beginners, is to focus solely on achieving a high win rate by taking quick profits and letting losers run, resulting in a poor RR, easy, winning 70% of trades but with only a 1.3 RR. This will invariably lead to losses over time, even with a high win rate.
That's a crucial insight. Okay, now for the uncomfortable yet absolutely universal truth of trading: losing streaks. So what does this all mean for encountering those inevitable periods? Because let's face it, losing streaks are not a sign of failure. They're a statistical reality that every single trader, no matter how good, will face.
Exactly. It's not if, it's when and how often. Even with a statistically strong strategy that has a 60% win rate over the long run, you can, with mathematical certainty, expect to experience a streak of 4 consecutive losses approximately every 70 trades or so.
4 in a row. Okay.
And the likelihood increases for longer streaks over more trades. You might expect 6 consecutive losses, roughly every 400 trades, and even 8 consecutive losses could occur about every 2,500 trades. These are just statistical probabilities for a 60% win rate system.
Sobering numbers.
They are. And managing these periods, both psychologically and financially, is absolutely paramount to your survival as a trader. Psychological preparation, truly understanding and accepting that these streaks are a normal, expected statistical occurrence, not a reflection of your failure, is key. Proper position sizing, like strictly adhering to that 1% or 2% risk rule per trade, is your primary financial safeguard.
How does sizing help specifically with streaks?
Think about it. Risking just 2% per trade means that even after 8 consecutive losses, which is statistically possible, though infrequent, your account drawdown would be around 15%. That's painful, yes, but generally manageable and recoverable, both financially and psychologically. In sharp contrast, if you were risking a much higher 5% per trade, those same 8 consecutive losses would result in a devastating 33.7% drawdown, a loss that large often triggers emotional panic, desperation, and the fatal decision to abandon a perfectly viable strategy right at its point of maximum drawdown.
Wow, that difference is huge.
It's the difference between staying in the game and blowing up. Implementing predefined drawdown rules, like reducing your position size further after a certain percentage drawdown, say 5%, taking deliberate breaks from trading during deep drawdowns to clear your head, and rigorously reviewing losses objectively without emotional reaction are all vital components of longevity in this business.
Okay, that covers handling losing streaks. What about the flip side? Winning streaks, surely that's easier.
You'd think so, wouldn't you? But what's fascinating here is that winning streaks can actually be just as psychologically challenging as losing streaks, sometimes even more dangerous in subtle ways.
Really? How so?
They often breed a dangerous sense of overconfidence and infallibility. This can subtly lead traders to increase their risk-taking, can't lose, start deviating from their proven plan, maybe I'll just tweak this rule, take bigger positions, or trade more frequently, ultimately setting themselves up for much larger, more painful losses when the market inevitably turns or their luck runs out.
The hot hand fallacy.
Exactly. During winning streaks, you must maintain absolute position size discipline. If you're using percentage-based sizing, your position size will naturally grow with your account balance. Let that compounding work, but resist the powerful urge to increase your risk percentage per trade. Stick to your documented strategy rules strictly, no exceptions. Consider taking regular profits according to your plan to lock in gains and reinforce good habits, rather than letting every winner run indefinitely hoping for a home run. And very importantly, objectively attribute your performance, how much was due to skill and following your process, and how much might have been due to favorable market conditions or just plain luck. Markets move in cycles. Discipline during the good times builds the essential foundation, the resilience, and the capital buffer needed for surviving and ultimately thriving during the inevitable tough times.
Okay, with risk management firmly in place as our absolute bedrock, let's now explore the proactive side again. The core types of data-driven strategies you can actually build and deploy. Once you have your foundational principles and your risk controls dialed in, it sounds like it's time to pick your fighting style, so to speak.
That's a good way to put it. Understanding the main strategy archetypes helps you identify what might align best with your own psychological profile, your market view, and the types of opportunities you're looking for. Broadly, we can categorize them into 3 main types. First, we have trend-following strategies.
Riding the wave.
Exactly. These aim to identify and trade in the direction of established, enduring market trends, buying in uptrends, selling in downtrends. They often have lower win rates, typically in the 40–50% range, but they compensate with potentially very high reward-to-risk ratios, sometimes 2.1, 3.1, even 5.1 or more, because they aim to capture large, sustained market moves.
Cut losses short, let winners run.
That's the mantra. They utilize tools like moving averages, like the 50 or 200-day, or the Average Directional Index, ADX, to confirm trend existence and strength. While they can capture significant, sometimes life-changing market movements, their weakness is that they are vulnerable to whipsaws getting chopped up by false signals in ranging or sideways markets, which realistically make up perhaps 60–70% of the time in many markets. These strategies are best suited for patient traders who are psychologically comfortable enduring multiple small losses in exchange for those larger, less frequent winning trades.
Okay, that's trend following. What's next?
Next are range or mean reversion strategies. These thrive in markets that tend to oscillate back and forth within a defined range rather than trending strongly. They trade moves back towards an average price, like a moving average or the center of a Bollinger Band, from perceived extreme levels.
Fade the extremes. Buy low, sell high within the range.
Precisely. These strategies typically boast higher win rates, often in the 50–70% range, because price does tend to revert to the mean quite often in the short term. However, they usually have lower reward-to-risk ratios, often around 1.1 to perhaps 1.5.1 as you're capturing smaller oscillations. They rely heavily on oscillators like RSI or stochastics to identify oversold conditions near the range boundaries, or tools like Bollinger Bands.
Okay.
These strategies offer frequent trading opportunities, which appeals to some traders. But their major risk is getting caught on the wrong side if a strong, unexpected trend suddenly emerges and breaks out of the range. Those losses can be catastrophic if not managed properly. Range strategies tend to suit more active traders who are adept at identifying and managing ranging market conditions and are comfortable with more frequent, smaller wins.
Right. Need to know when the range breaks. What's the third type?
Finally, we have breakout strategies. These aim to capitalize on the significant price moves that often occur when price decisively breaks through key technical levels, like established support or resistance lines, trend lines, or the boundaries of chart patterns like triangles or rectangles.
Trading the start of a potential new trend.
Exactly. You're anticipating that the break will lead to continued momentum in that direction. These strategies typically have moderate win rates, maybe 40–60%, and moderate reward-to-risk ratios, perhaps 1.5.1 to 3.1. They use clearly defined support resistance levels, chart patterns, and often volume confirmation to help validate the legitimacy of a breakout.
Volume confirming the move.
Yes, higher volume on the break is often a good sign. While breakout strategies can capture the very beginning of major market moves, their main challenge is dealing with frequent false breakouts, or fakeouts, where price breaks a level only to quickly reverse back. This requires decisive entry timing and very swift risk management if a breakout fails. These strategies are often best suited for decisive traders who are comfortable acting quickly and managing the uncertainty inherent in breakouts. Ultimately, your choice of strategy type must profoundly align with your psychological profile, your available time commitment, and your capital base.
Trend following, mean reversion, breakout.
Got it. Okay, let's get even more concrete now with some specific examples that showcase these different styles in action. For maybe the shorter-term day traders out there, you mentioned the London breakout strategy earlier. Could you walk us through the specifics of that one? Certainly. The London breakout strategy is a classic day trading approach that's particularly effective on major liquid forex pairs like EUR-USD, GBP-USD, or maybe USD-JPY. It specifically aims to capitalize on the predictable increase in volatility and liquidity that often accompanies the opening of the London trading session, which is a major global financial center.
Trading the open. Okay, what's the logic?
The core logic is this. The preceding Asian trading session, typically running from around 00000000 GMT, is often characterized by lower volatility and tighter price ranges as European and U.S. markets are closed. The London Open, around 08.000 GMT, frequently sees a surge in trading activity as major banks and institutions come online, often leading to a directional breakout from this established Asian range.
Makes sense. More players joining the game. How do you set it up?
The setup is straightforward. You identify the absolute highest price, the high, and the absolute lowest price, the low, reached during that defined Asian session, typically looking at a 15-minute or 30-minute chart. This defines your Asian range.
Okay, got the range. How do you trade the break?
For the entry, you place pending orders before the London Open. Specifically, a buy stop order, usually 10 pips above the Asian session high, and a sell stop order 10 pips below the Asian session low. When London opens and volatility picks up, one of these orders will likely be triggered if price breaks out. Crucially, many traders add a confirmation filter, like using a short-term moving average, say the 50 EMA on the 15-minute chart. They only take the buy stop if price is already above the EMA, or the sell stop if price is below the EMA, ensuring they are trading with the prevailing intraday momentum once it establishes itself.
Smart filter. What about exits?
For the exit, the take-profit target is typically set at a multiple of the Asian range itself, often 2 times the height of the Asian range projected from the breakout point. The stop loss is usually placed either at the midpoint, 50% of the Asian range in the opposite direction, or sometimes just beyond the other side of the Asian range. There's also often a time-based exit rule. If neither the profit target nor the stop loss is hit by a certain time, say 16.00 GMT, late afternoon London time, any remaining open position is closed out to ensure no overnight risk is carried.
Okay, and risk management.
Risk management is key here. Strict 1% risk per trade based on the stop-loss distance. Avoid trading this strategy right before major scheduled news releases that could cause erratic, unpredictable volatility. And some traders add filters to skip setups where the initial Asian range is either too narrow, or usually less than 30 pips, suggesting low potential for a strong breakout, or too wide, for anything greater than 80 pips, suggesting the move might already be exhausted before London even opens.
What kind of performance can you expect?
Based on historical testing, this type of strategy often yields around a 55% win rate with a fairly consistent 2.1 reward-to-risk ratio. This results in a healthy, positive expectancy, maybe around 0.65 R per trade on average. It's a really good example of a simple, data-driven approach designed to exploit a specific, recurring intraday market anomaly.
That's a really clear short-term example. How about something for the medium-term traders, the swing traders? Perhaps using gold as an example, as you mentioned its characteristics earlier.
Absolutely. For swing traders looking at holding positions for a few days to maybe a couple weeks, the gold pullback strategy on the XAUSD pair is an excellent example of a trend-following approach adapted for that time frame. This strategy aims to enter established gold trends during temporary counter-trend pullbacks, capitalizing on gold's known tendency to respect key technical levels during trends.
Buying the dips in an uptrend, selling the rallies in a downtrend.
Precisely. The logic is that gold often experiences strong, sustained trends driven either by its safe haven appeal during uncertainty or its role as an inflation hedge. However, these trends are rarely linear. They move in waves, featuring pullbacks or corrections against the main trend. These pullbacks offer potentially lower risk entry points if you anticipate the overall trend is likely to continue.
Okay, how do you confirm the trend first?
First, you need trend confirmation on a higher time frame, typically the daily chart for swing trading. You'd confirm the overall trend direction by observing price action relative to key moving averages, for example. Is price consistently trading above both the 50-day and 200-day EMAs for a confirmed uptrend, or below them for a downtrend?
Get the main direction. Now, how do you time the pullback entry?
For the pullback entry, you then drop down to your execution time frame, usually the 4-hour chart. You wait patiently for price to pull back towards a dynamic support level in an uptrend or a resistance level in a downtrend. Often the 50 EMA on the 4-hour chart is a key reference point. You'd look for confirmation that the pullback might be ending. This could come from the RSI indicator showing oversold conditions below 30 at the pullback low in an uptrend or overbought above 70 at the pullback high in a downtrend. You'd also look for a confirming bullish or bearish candlestick pattern right at that potential turning point, like a hammer, a bullish engulfing pattern for longs, or their bearish counterparts for shorts. Ideally, the entry point often occurs within the 38.2% to 50% Fibonacci retracement zone of the most recent prior swing, the impulse leg in the direction of the main trend.
Lots of confluence factors there. What about the exits?
For the exit, the initial take profit target is typically set just before the previous major swing high in an uptrend, or swing low in a downtrend, as these are logical areas where the opposing pressure might resume. The initial stop loss is placed logically just beyond the recent swing point that marked the end of the pullback, the low of the pullback for a long, the high for a short. If price goes beyond this point, the trend continuation idea is likely invalidated. Many traders also employ a trailing stop after the trade reaches the 1.1 reward-to-risk ratio, allowing them to lock in some profit while still participating if the trend continues strongly.
And the risk rules.
Risk management. Limit risk to perhaps 1.5% of account capital per trade, slightly higher than day trading may be, due to the larger potential targets. Avoid entering right before major economic releases, like FOMC announcements or non-farm payrolls, that could cause unpredictable spikes in gold prices. Prudent portfolio management would suggest limiting the number of open positions concurrently, say, to a maximum of 3 to manage overall market exposure. And definitely implement drawdown rules, such as reducing position size temporarily after experiencing a 5% account drawdown.
What's the typical performance profile?
This type of pullback strategy typically shows a somewhat lower win rate, perhaps around 45%, because you're trying to pinpoint the end of corrections, which isn't always easy. However, it often compensates with a strong average reward-to-risk ratio, maybe 2.5, 0.1, or even higher, as you're aiming to capture the next leg of the established trend. This combination can lead to a very healthy positive expectancy, potentially around 0.7 R per trade, clearly showcasing how lower win rates can still be highly profitable when combined with good RR management.
Okay, trend pullback covered. What about a mean reversion example for those ranging market conditions you mentioned?
Right. For identifying opportunities specifically within ranging or sideways markets, a common approach is the Bollinger Band squeeze strategy, often applied to major Forex pairs, which can spend significant time consolidating. This is a classic mean reversion strategy that first identifies periods of unusually low volatility before anticipating an expansion and a potential reversion back to the mean.
Low volatility predicting high volatility.
Often, yes. The logic is based on the behavior of Bollinger Bands. These bands naturally contract or squeeze together during periods of low market volatility. This squeeze often signals that a period of higher volatility and a potential directional move, either a breakout or a strong reversion, is likely imminent once volatility returns. This specific strategy often focuses on trading the mean reversion aspect after an initial volatility expansion.
Interesting. How's the setup?
The setup involves identifying these low volatility periods. A common technique is to look for times when the Bollinger Bands, typically set at 20 periods, 2 standard deviations, are actually trading inside a wider set of Keltner channels, often set at 20 periods, 1.5 ATR. This BB squeeze highlights extremely compressed volatility. Once price makes a move outside the squeezed Bollinger Bands, volatility expands, you then wait for a signal suggesting it might revert back towards the middle band.
And the entry trigger.
For the entry. For a potential short sell position, you'd look for price to touch or briefly exceed the upper Bollinger Band, while the RSI indicator is simultaneously showing an overbought reading, RGM 70. You'd want confirmation with a bearish rejection candlestick pattern right at that upper band. For a potential long buy, it's the inverse. Price touches or briefly penetrates the lower Bollinger Band, RSI is showing oversold, RGM 30, and you get a bullish rejection candle.
Fading the edges after a volatility pop. What about exits?
The primary exit target for a mean reversion trade like this is typically the middle Bollinger Band, which is simply the 20-period simple moving average. The stop loss is placed logically just beyond the extreme point of the entry candle or the recent minor swing high-low that formed at the band touch. Some traders also use a time-based exit, closing the position after, say, 16 candles if the middle band target isn't reached, as mean reversion moves often tend to play out relatively quickly or fail.
Risk management considerations.
Risk management. Standard 1% risk per trade. Strictly avoid trading this around high-impact news releases. And crucially, this strategy relies on the market being in a range. So you typically skip entries if a trend strength indicator like the ADX is showing a strong trend, for example, ADX 30. Trying to fade extremes in a strongly trending market is a recipe for disaster. Also, limit concurrent positions, maybe a maximum of 2 open trades.
Performance expectations.
This type of strategy often achieves a higher win rate, perhaps around 65%, because prices do frequently oscillate. However, the reward-to-risk ratio is typically lower, often around 1.2.1 as you're targeting the middle band. Not a huge move. This might yield an expectancy around 0.48 R per trade. The vital warning here is that mean reversion strategies suffer significantly during strong, sustained trends. Confirming the market context is truly arranging is absolutely paramount for this style.
Okay, one more type. Momentum. Can you give an example of a momentum-based strategy?
Sure. A common example is a momentum strategy using the MACD indicator, suitable perhaps for trending periods in Forex or gold. This is essentially a trend-following approach, but focuses specifically on identifying periods of strong, accelerating momentum within that trend.
Trying to jump on board when the trend is moving fastest?
Exactly. The logic is that strong trends are often characterized by periods of powerful momentum. This strategy uses the MACD indicator, often in conjunction with higher time frame trend confirmation, to identify these periods and align trades with the direction of the dominant force.
How does it work?
First, as always, trend confirmation on a higher time frame like the daily chart using EMAs. For example, price consistently above the 8 and 21 EMAs might indicate a strong short-term uptrend. Then, for momentum entry signals, you drop down to your execution time frame, maybe the 4-hour chart. You look for the MACD line to cross above its signal line for buys or below for sells. You want to see confirmation that the MACD histogram bars, which represent the difference between the two lines, are increasing in size, indicating accelerating momentum. And ideally, you'd also want the ADX indicator to be above 25, confirming that a strong trend is indeed in progress.
Combining MACD signals with ADX confirmation, how do you enter and exit?
The entry is often taken simply at the market close of the 4-hour candle that confirms all these conditions. For the exit, a common approach is to exit the trade when the MACD line crosses back below its signal line for a long trade or back above for a short trade, suggesting momentum is waning. The initial stop loss is placed logically below the recent swing low for a buy or above the recent swing high for a sell. Implementing a trailing stop after the trade reaches a 1.1 RR is also a common tactic to protect gains while allowing for further trend continuation.
Risk approach.
Risk management, maybe 1.5% risk per trade. It's generally advised not to trade momentum strategies against the higher time frame trend, but if you do as part of a more complex system, definitely reduce position size significantly. Skip setups right before high-risk news events. And be mindful of correlations limit exposure by trading maybe a maximum of 3 highly correlated pairs simultaneously.
Performance profile for momentum.
Momentum strategies typically yield a win rate similar to trend following, perhaps around 45% as you're still dealing with the choppiness of trends. However, they often achieve a solid average reward-to-risk ratio, maybe 2.2.1, leading to a respectable expectancy around 0.54 R per trade. The key thing to remember is that momentum strategies thrive in strongly trending, volatile markets. but tend to struggle significantly and generate false signals during low volatility ranging periods. Market context is everything.
Okay, we've covered a really fascinating array of strategy types and some very concrete examples. Now let's transition from the grand strategic plan to the precise moment of action. What does all this mean for actually getting into a trade? We need precision in action, right? How do you actually place the order?
Absolutely. Trade entry techniques are all about how you execute your carefully planned strategy with precision and efficiency. There are three main order types you need to understand. First, market orders.
The simplest one.
Often, yes. They execute immediately at the current best available price in the market. This guarantees you get filled, get into the trade now, but it comes with the potential for slippage, especially in very fast-moving or volatile markets. Slippage is the difference between the price you expected when you click the button and the price your trade actually executed at. Market orders are often best used for fast-moving breakout scenarios where getting in immediately is deemed more important than getting the absolute perfect price.
Okay, what else?
Second, you have limit orders. These allow you to specify the exact price, or better, at which you are willing to buy or sell. This gives you excellent price control. You won't get filled at a worse price than you specified. However, it comes with no guarantee of getting filled at all. The market might move away from your limit price before your order can be executed. Limit orders are ideal for range-bound trading or entering on pullbacks where you're patiently waiting for price to come back to a specific favorable level.
Waiting for your price. Got it. Third type.
Third are stop orders, specifically stop entry orders, not to be confused with stop loss orders. These trigger a market order only when the price reaches a certain level beyond the current market price. They are often used to automate breakout entries, NAG, place a buy stop order above a resistance level. However, like market orders, they can experience slippage once triggered, and if the breakout move is extremely aggressive, they can sometimes lead to a slightly late entry compared to watching it live.
Market limit. Stop. Okay. Any more advanced techniques?
Yeah, for more refinement, traders might use techniques like scaling in. This means entering a full position in multiple smaller portions over time rather than all at once. This can help reduce initial risk or allow you to average your entry price if the market moves slightly against you initially. There's also micro-testing, where you might test a new setup or variation with a tiny, almost negligible position size in a live account before committing larger capital. Or implementing time-based entries, consciously choosing to execute trades only during specific times of day, known for favorable volatility or liquidity characteristics like the London Open we discussed, or maybe the New York Open.
Precision matters. Now, you've hinted before that exits might be even more important than entries. Let's talk about exit rules and scaling out. How do you protect your profits effectively?
You're right. Many experienced traders argue that exit strategies are often more critical than entries for determining overall profitability. Getting out well is crucial. For fixed target exits, you might use predetermined technical levels identified on your chart, major support resistance zones, key Fibonacci extension levels. Or you could use a simple R multiple target based on your initial risk exiting automatically when the trade hits, say, 2R or 3R profit. Some strategies might use indicator-based exit signals or exit when a specific chart pattern completes.
What about letting winners run further?
That's where trailing exits come in. These methods dynamically adjust your stop loss upwards for longs or downwards for shorts as the trade moves in your favor, aiming to lock in profits while still allowing the trade to capture a larger potential move if the trend continues strongly. Common trailing methods include the chandelier stop, which places the stop a certain multiple of the average true range away from the recent price extreme, using a moving average as a trailing stop, the parabolic SAR indicator, or simply trailing the stop behind significant swing points as they form.
And scaling out, you mentioned that too.
Yes, scaling out involves exiting your position in portions at different price levels, rather than closing the entire trade at once. A popular method, as mentioned, is the rule of thirds. Maybe exit 13 of your position when it reaches a 1.1 reward. Risk ratio, locking in some profit and covering initial risk, exit another 13 at a 2.1 RR target, and then trail the stop loss on the final 13 to potentially capture a much larger move. This strategy significantly improves psychological comfort for many traders because it locks in partial profits along the way, reducing the all-or-nothing pressure of trying to make perfect exit decisions on the entire position.
That sounds psychologically much easier to handle. Okay, we've touched on many powerful indicators throughout this deep dive: EMAs, RSI, MEXC/D, Bollinger Bands, ADX. So what does this all mean for actually using them effectively together? Is more always better when it comes to indicators? Should we just slap 5 or 6 onto our charts?
Definitely not. That's a very common mistake. The misconception is that more indicators layered on top of each other somehow equate to more certainty or a better signal. In reality, the key principle is confluence.
Confluence.
Confluence means looking for multiple different types of indicators or analytical tools to confirm the same trading thesis or signal, creating a stronger, more reliable, higher probability setup. You should aim to combine complementary indicators that measure different aspects of price action. For example, combine a trend indicator like an EMA with a momentum indicator like RSI or MACD, or maybe a volatility indicator like Bollinger Bands with a volume indicator. The goal is to build a multifaceted view, getting confirmation from different angles.
Avoid using similar tools together.
Absolutely critical. Avoid redundancy. Don't use multiple similar indicators like using both RSI and stochastic and another oscillator, as they are often highly correlated and essentially tell you the same thing. This just creates a false sense of confidence without adding real confirming value. Always seek price confirmation because remember, all indicators are derivatives of price itself. The raw price action on your chart should always be your ultimate guide and should confirm what the indicators are suggesting. And try to balance leading versus lagging combinations. Leading indicators like oscillators might give earlier signals but more false ones, while lagging indicators like moving averages provide confirmation but get you in later. Combining them intelligently can offer a good balance.
So effective combinations might be
Things like trend plus momentum, e.g. moving averages confirming trend direction, with arithmetic divergence or crossover providing the entry trigger. Or volatility plus support resistance, e.g. price hitting an outer Bollinger Band that coincides with a key Fibonacci retracement level. Or price action plus volume, e.g. a bullish, engulfing candlestick pattern confirmed by a significant surge in volume. That's where the real edge often lies in the intelligent combination, not the quantity.
Okay, that makes sense. Now, moving towards potentially greater efficiency or handling more complex systems, can you distinguish between what's meant by rule-based trading systems and fully algorithmic trading systems? Is there a spectrum?
Yes, there's definitely a spectrum, ranging from purely discretionary to fully automated. Rule-based trading systems generally refer to approaches, often executed manually or semi-automatically, where you have very clear, objective rules defined for every aspect of the trade entry, exit, risk, position sizing. Human oversight and execution are still heavily involved. These offer flexibility and allow for human judgment in ambiguous situations, but they remain susceptible to human psychological biases during execution and are limited by human reaction speed.
Okay, rules but human control. What about algorithmic?
Algorithmic trading systems, often called algos or trading robots or expert advisors in the MetaTrader world, involve fully programmed rules that are executed automatically by a computer with little or no human intervention once turned on. They offer unparalleled speed, execution precision, the ability to monitor and trade across multiple markets simultaneously 24/7, and complete removal of emotional decision-making at the point of execution. However, they require significant programming skills to develop and test, are vulnerable to technical failures, bugs, connection issues, and demand diligent monitoring and maintenance.
So it's not just set and forget.
Absolutely not. That's a dangerous myth. Many data-driven traders actually adopt hybrid approaches. They might use algorithms for automated signal generation or market scanning, but then execute the trades manually based on those signals. Or they might have automated execution systems, but maintain human oversight to intervene during unexpected market events or system issues. This tries to leverage the strengths of both human pattern recognition and intuition with the discipline and speed of machine execution.
For those listeners who might have some coding interest or background, you mentioned custom indicators. Can building your own tools provide a unique edge? And what are the main platforms like PineScript or MQL?
Building custom indicators or even simple automated strategies can definitely provide a unique, tailored edge as you're creating tools specifically designed to capture the market patterns you have identified, rather than relying solely on standard, widely available indicators. The two main platforms for retail traders are PineScript, which is used within the TradingView platform. It's generally considered easier to learn, it's cloud-based, and has a large, very active community sharing scripts and ideas. It's excellent for creating sophisticated custom indicators and relatively simple automated strategies that can trigger alerts or webhooks.
Okay, PineScript for TradingView. What's MQL?
MQL, specifically MQL4 and MQL5, is the MetaQuotes language used for the hugely popular MetaTrader 4 and MetaTrader 5 platforms. MQL is significantly more powerful and flexible than PineScript, being based on C++4. It allows for the creation of complex, fully autonomous trading robots, expert advisors or EAs, that can manage trades entirely on the platform. However, it comes with a much steeper learning curve compared to PineScript. The development process for either typically involves identifying the specific market pattern or logic you want to capture, defining the precise rules, coding those rules into your chosen language, and then rigorously backtesting, debugging, and optimizing the custom indicator or strategy within its respective platform.
Okay, and for those going even further into full automation, what are the basics they need to consider?
For building fully automated trading systems, the essential components you need to assemble include your carefully crafted and tested strategy logic, the core rules, an execution engine, the software environment that runs your code like MetaTrader or a custom Python script, a reliable real-time data feed, connectivity to your broker's API, application programming interface, to send and manage orders electronically, and, crucially, robust risk control modules embedded directly within the code itself, like maximum position size limits, daily loss limits, etc.
Platforms for this.
Popular platforms range from using MetaTrader Expert Advisors, EAs, to building systems in Python using libraries like Pandas for data analysis and specific broker APIs for execution, or even using TradingView webhooks to connect PineScript alerts to external execution platforms or bots. The implementation process always involves phases. Thorough paper testing, running the algo on a demo account without real money, then cautious small live testing with minimal capital, followed by very gradual scaling of position size as confidence builds, and absolutely critical continuous monitoring of its live performance and operation. A crucial warning, though, automation introduces new layers of technical risk, bugs, platform outages, data errors. Always implement multiple fail-safes like daily loss limits, maximum drawdown stops coded into the system, and maintain a robust monitoring process to ensure your algorithms are operating exactly as intended. It's powerful, but requires diligence.
That's a really comprehensive look at execution and automation options. Now, let's talk about something that often gets, well, kind of neglected by aspiring traders, but is absolutely non-negotiable for achieving lasting success. Here's where it gets really interesting, I think. If you genuinely treat trading like a serious business, then your trade journal isn't just some optional record. It's effectively your financial statement, your performance review dashboard, and ultimately your most powerful learning tool rolled into one. Why is it so critical that you must track every single trade?
You framed it perfectly. It truly is the absolute bedrock of long-term improvement and sustainability in this field. The benefits of rigorous, detailed record keeping are profound. First, it provides objective performance measurement. It gives you hard data, actual metrics to evaluate your trading, not just fuzzy memories or feelings about how you think you did.
Facts, not feelings again.
Exactly. Second, it enables crucial pattern recognition in your own trading behavior over time. You could discover hidden patterns, which specific setups consistently work best for you, at what times of day you perform better or worse, or under what specific market conditions your strategy excels or struggles, things you'd never spot otherwise.
Insights about yourself.
Deep insights. Third, it offers invaluable psychological insights. By noting your mindset and emotions around each trade, you can start to precisely identify recurring emotional triggers that lead to poor decisions or deviations from your plan, like trading out of boredom, fear, or overconfidence after a win. Fourth, detailed data facilitates precise strategy refinement. It allows you to optimize your rules and parameters based on actual real-world trading results, not just theoretical backtest data. And finally, it fosters unwavering accountability. Just the act of knowing you have to record every detail, including why you took the trade and if you followed your plan, actively discourages impulsive plan-violating trades. Peter Drucker famously stated, "If you can't measure it, you can't improve it." This really raises an important question for you, the listener. Are you truly measuring what matters most to your trading right now, or are you just focusing on the P&L of individual trades, missing the bigger picture?
That Drucker quote is spot on. So what goes into a great trade journal? It sounds like it needs to be much more than just simple entries of buy-sell prices and P&L.
Absolutely. A truly great, effective trade journal goes far beyond simple accounting. It should meticulously include, of course, the trade basics. The instrument traded, entry and exit prices, position size, commission costs, and the final profit or loss expressed both in currency and in R multiples, your risk units.
Okay, the essentials.
But then, crucially, it needs comprehensive technical details. This means saving screenshots of your chart before you entered, during the trade if possible, and after it closed. Mark up these charts showing your analysis, key levels, the specific setup triggers, prevailing market conditions, was it trending, ranging, volatile, and the multi-time frame context at the time of entry.
Visual context is key.
Hugely important for review. You must also honestly record psychological factors. What was your mental state and confidence level before entering? What emotions, fear, greed, hope, frustration did you experience during the trade? And critically, did you deviate from your trading plan in any way? And if so, why? Be brutally honest here.
Nobody else needs to see it, right?
It's exactly. This is for your improvement. Finally, dedicate a specific section in your journal entry to post-trade analysis. Objectively assess what worked well in the trade, even if it was a loser but you follow the plan, what could be improved in terms of analysis or execution, identify specific lessons learned from that particular trade, and jot down concrete ideas for potential strategy refinement or future testing based on that trade's outcome. Whether you use a digital spreadsheet like Excel or Google Sheets, specialized journaling software, or even a discipline-written notebook, numerous studies and anecdotal evidence consistently show that detailed journaling significantly improves trading performance over time, not just from the direct insights gained, but also from the inherent discipline and mindfulness the process itself cultivates.
Okay, so rigorous journaling is vital. Now, to prevent those impulsive, plan-violating decisions that wreck so many accounts, you need a powerful gatekeeper before every single trade. It's about turning trading into a systematic, professional procedure, not just a reactive impulse. That's where the pre-trade checklist comes in, right?
Absolutely. The pre-trade checklist is your essential discipline gatekeeper. It's a simple but incredibly effective tool that forces you to systematically pause and assess critical factors before you even consider clicking the buy or sell button, preventing so many costly, emotionally driven mistakes made in the heat of the moment.
What should be on that checklist?
It covers several key areas. First, a thorough market condition assessment. Is your specific strategy actually appropriate for the current overall market environment? Is the market trending strongly, ranging sideways, or highly volatile? Does your strategy work well in these conditions? Also, quickly check the economic calendar for any imminent high-impact news releases that could inject unpredictable volatility and potentially invalidate your technical setup.
Context first.
Always. Second, perform your multi-timeframe analysis. Verify if the potential setup aligns with the trend and key levels on your higher timeframes. Does the bigger picture support this trade idea? Third, rigorous strategy criteria verification. Go through your specific strategy rules one by one. Are all the predefined conditions demonstrably met on the chart? Actively guard against confirmation bias, seeing only what you want to see to justify the trade. Be objective.
Stick to the rules.
Non-negotiable. Fourth, a precise risk assessment. Calculate your exact position size based on your predetermined risk percentage, for example, that 1-2% of current account balance. Define your precise stop-loss level based on your rules. Verify that the potential reward-risk ratio of the trade meets your minimum requirement. For example, is it at least 2.1? Fifth, clear execution planning. Decide beforehand the appropriate order type, market, limit, stop, you'll use to enter. Do you have contingency plans if the market gaps or moves quickly? Maybe set price alerts. And finally, sixth, psychological readiness. Honestly assess your current mental state. Are you focused, calm, and objective? Or are you feeling tired, stressed, anxious, or overly excited from previous win or loss? Avoid trading when you're not in the right headspace. This comprehensive checklist prevents those common errors made by overlooking critical factors in the excitement or pressure of a potential trading opportunity. It forces trading into a disciplined professional procedure.
That sounds like a lifesaver. Okay, so you've used the checklist, taken the trade, managed it, and closed it. Now what? The post-trade review process. This sounds like where the real learning happens.
It absolutely is. This is your primary learning engine. Effective post-trade review typically involves two levels. First, there's an immediate review, ideally conducted on the same day the trade is closed, while the details and your feelings are still fresh. This involves meticulously documenting all the trade details in your journal, as we discussed, objectively analyzing your execution. Did you follow your plan perfectly from entry to exit? And honestly assessing the emotional impact the trade had on you.
Capture it while it's fresh.
Exactly. Then there's a delayed review, conducted perhaps weekly or monthly, looking at your trades in aggregate. This is where you calculate your overall performance metrics, win rate, profit factor, expectancy drawdown for that period. You look at recurring patterns across multiple trades. What types of setups are working best? Are you making consistent errors? How does your performance vary under different market conditions? This broad review is crucial for identifying statistically significant patterns and making informed decisions about strategy refinement.
Okay, immediate and delayed. You mentioned a specific framework, the 3 M's.
Yes, a very useful framework for the review process, especially the immediate review, is the 3M post-trade review, MARC. Objectively grade your execution of the trade on a scale of, say, 1 to 10. This grade should be based purely on how well you adhere to your predefined trading plan, not on the profit or loss outcome of the trade itself. A perfectly executed trade according to your rules that resulted in a loss gets a high mark, for example, 910. A sloppy rule-breaking trade that luckily resulted in a win gets a low mark, for example, 310. This decouples process from outcome. Measure. Quantify the trade's performance objectively using R multiples, example, plus 2.5R, manage 1R. This standardizes results regardless of your account size or the instrument traded, allowing for meaningful comparison across trades. Master. Based on your market measure, identify one specific actionable improvement related to your process or execution that you will consciously focus on implementing in your very next trading session or trade. This focus on small, incremental, process-oriented improvements leads to compounding skill development over time.
Mark, measure, master. I like that. Very actionable. How do you dig deeper into the journal data once you have a decent number of trades recorded?
To truly unearth those hidden insights from your growing trade journal, trade tagging and filtering becomes indispensable. This involves systematically categorizing or tagging each trade in your journal with consistent labels for various factors.
Like keywords.
Exactly like keywords. You might tag by the specific strategy setup type used, GC London breakout, gold pullback, RSI divergence. The prevailing market conditions at the time, GC strong uptrend, ranging, high volatility, post-news. The technical context, GC aligned with daily TF, at key resistance, EMA cross. And crucially, relevant psychological factors, e.g. felt confident, hesitated on entry, exited early fear.
Okay, so you tag everything consistently. Then what?
Once you accumulate a reasonable number of tag trades, usually 30 or more, ideally 5,100 plus for statistical significance, you can then filter and sort your journal data based on these tags to reveal powerful patterns. You can analyze the performance of specific strategies or setups under different conditions. How market volatility or trend strength impacts your results. Whether you perform better or worse during certain market sessions or days of the week. Correlations between your recorded emotional states and your P&L or execution quality. What's truly fascinating here is that many traders, through this kind of detailed analysis, discover unexpected correlations or patterns in their own trading, like realizing they consistently lose money trading a certain instrument on Friday afternoons, or that their best trades always come after a specific chart pattern forms on the higher time frame patterns they never would have consciously considered without rigorously analyzing their tag data.
It sounds like mining for personal trading gold. What specific kinds of performance patterns should people be looking for when they analyze their journal data?
You're looking for any statistically significant patterns that can lead to actionable improvements. This includes analyzing setup-specific performance. Which of your strategies or entry setups consistently generate the highest positive expectancy? Which have the best risk-adjusted returns? For example, highest Sharpe ratio. How does their performance vary in trending versus ranging markets?
Find your A-plus setups.
Precisely. Look for time-based patterns. Are there specific days of the week or times of day when your performance is significantly better or worse? Does your strategy perform differently around recurring economic events or market opens closes? Analyze psychological patterns. Does the outcome of your previous trade impact your decision-making on the next one? For example, becoming overly aggressive after a loss. Is there a correlation between your pre-trade confidence level and the trade outcome? Are you consistently making certain types of execution errors, e.g. moving stops too soon? And evaluate risk management effectiveness. Is your chosen position sizing model working well? Are your stop-loss placements effective, or are you getting stopped out too often by noise? Are your take-profit strategies leaving too much money on the table, or are you exiting too early?
How do you visualize or quantify these patterns?
Several techniques help. Equity curve analysis involves plotting your cumulative profit loss in R multiples over time. This visually shows your consistency, the steepness of your growth, and the depth and duration of your drawdowns. Drawdown analysis specifically examines the characteristics of your losing periods. What's the maximum percentage decline? How long do they typically last? How quickly do you recover? Trade cluster analysis involves grouping similar trades together based on your tags to identify the specific combinations of factors, setup plus market condition plus time of day, etc., that yield the highest edge. And for more advanced analysis, using statistical significance testing helps ensure that the patterns you identify are likely real and not just random fluctuations in your data, preventing you from optimizing based on noise.
That's incredibly thorough, really trading like a science. So pulling this all together for the path to mastery, what does this all mean? It really sounds like the most significant, lasting improvements often come not just from finding slightly better strategies or indicators, but from understanding yourself much better as a decision maker under pressure.
You've perfectly encapsulated the core message. We often champion what could be called the 20-20-60 rule for trading improvement. Maybe 20% of your improvement potential comes from further strategy development and refinement. Another 20% comes from honing your execution skills, getting better at placing orders, managing trades, using your platform. But the dominant 60%, arguably the lion's share of long-term sustainable success, comes from developing self-awareness and mastering your psychology. Elite traders, the ones who last, understand themselves, their biases, their emotional triggers, their decision-making patterns under stress as profoundly as they understand the markets themselves. It involves a continuous, virtuous cycle. Analysis, objectively examining your performance data and psychological journal. Generating insight, developing actionable hypotheses about what needs to change. Adaptation, implementing deliberate, specific changes to your process or mindset. And then measurement, rigorously tracking the impact of those changes. The truly profound growth comes from this iterative process of self-review, adaptation, and refinement. It makes trading mastery a deeply personal, ongoing journey of self-discovery.
Okay, let's unpack this final section and bring everything together. We've covered a huge amount of ground today, really laying out a comprehensive blueprint for achieving success in the markets using a data-driven approach. You've just taken a really deep dive into transforming your trading, moving away from that often unpredictable world of gut feelings and towards the structured, evidence-based realm of the professional.
Indeed. We've hammered home the core tenets of this data-driven approach, making strictly evidence-based decisions, employing a rigorous and systematic methodology in everything you do, relentlessly quantifying and managing risk, implementing meticulous performance measurement through journaling and analysis, committing to continuous iterative improvement, and building a robust psychological structure to handle the inevitable ups and downs. Let me leave you with a powerful quote that I think perfectly summarizes this crucial shift in mindset. In trading, the amateur focuses on making money. The professional focuses on collecting and applying data. The money follows as a natural consequence. That is the transformative shift we're really advocating for you today.
Collect and apply data, let the money follow. I like that. So what's the next critical step for someone listening who's inspired to adopt this approach?
The next critical step is to formalize everything by building your comprehensive trading plan. This document is much more than just a piece of paper. It's your personal trading constitution. It's the governing document for your entire trading business, outlining exactly how you will operate.
What absolutely needs to be in that plan?
It must include several essential components. Your overarching trading philosophy and goals, incorporating those SMART goals, and your personal trading mission statement we discussed. Your clearly defined market and time frame selection. What will you trade and on what charts? A detailed strategy definition section for each strategy you intend to trade. This needs the precise entry rules, exit rules, stops and targets, risk management parameters, and ideally visual examples from charts illustrating the setups. Your overall risk management framework detailing your position sizing model, example 1% fixed percentage risk, maximum drawdown rules, correlation considerations, etc. Your specific execution procedures, including your pre-trade checklist, preferred order types, and trade management protocols. Your disciplined record-keeping system. How exactly will you journal your trades and conduct reviews? And finally, clear psychological guidelines outlining how you plan to manage common emotions like fear and greed, maintain discipline, and handle winning and losing streaks according to your plan.
That sounds incredibly detailed, but necessary.
It is. And crucially, this isn't a document you write once and forget. It's a living plan that requires consistent adherence every single trading day and deserves regular, perhaps quarterly, reviews and updates based on your ongoing performance analysis and evolving insights. It's your roadmap and your rulebook combined.
Okay, a living document. To help listeners bridge the gap from all these concepts to actually implementing them, could you provide a final practical checklist, like a journey map from initial idea right through to execution?
Absolutely. Here's a concise checklist summarizing the journey for applying these concepts to develop and launch a strategy. 1. Research and discovery. Spend time observing the market, identify potential recurring patterns or inefficiencies, formulate a clear, testable hypothesis, and define your initial strategy rules. 2. Testing and validation. Rigorously backtest your strategy over a significant historical period. Aim for a minimum of 200 trades if possible. Conduct walk-forward analysis if feasible. Test across multiple instruments or market conditions. Calculate all key performance metrics. Win rate, RR, expectancy, drawdown, Sharpe ratio. Be brutally honest about the results. 3. Documentation and planning. Meticulously document all strategy rules, including visual examples on charts. Define all risk parameters precisely. Outline your execution workflows. Compile everything into your comprehensive trading plan. 4. Demo trading. Execute the strategy faithfully on a demo account for a sustained period. Aim for at least 20-50 trades. Journal every single demo trade as if it were real money. Compare the demo performance metrics to your backtest expectations. Refine your execution skills and platform familiarity.
5. Live implementation. Only if demo trading confirms viability and consistency, begin live trading, but start with a significantly reduced position size, c.g. maybe 25% or 50% of your standard 1 to 2% risk. Initially, focus relentlessly on strict discipline and following your plan. Document everything. Scale your position size up gradually only as you demonstrate consistent, profitable execution according to plan. 6. Continuous refinement. Conduct regular monthly reviews of your live trading performance using your journal data. Identify areas for improvement in your strategy or execution. Test any significant changes on demo first before implementing them live. Repeat the cycle.
That's a fantastic step-by-step guide. Now, knowledge is certainly power, but as we know, avoiding common traps is often the secret to survival in the challenging world of trading. What are some critical pitfalls that our listeners should be particularly forewarned about as they embark on this data-driven journey?
Yes, the pitfalls. Forewarned is definitely forearmed here. The market is littered with these traps, and being acutely aware of them is half the battle. A huge one is strategy hopping, constantly jumping from one system to another, abandoning a perfectly viable strategy too soon, often right during a normal, expected drawdown period, always searching for that mythical perfect system that doesn't exist.
The grass is always greener.
Exactly. We talked about over-optimization or curve-fitting, creating strategies that look incredible in backtest, but fail miserably live because they were fitted to historical noise. Ignoring transaction costs like commissions and slippage is another common one. These costs can significantly erode the profitability of high-frequency strategies if not properly accounted for in testing and execution. Psychological override is massive, letting fear, greed, boredom, or impatience dictate your trading decisions instead of your rigorously tested plan.
Letting emotions take the wheel.
The classic mistake. Position sizing errors, risking too much per trade, create excessive emotional stress and are the fastest way to blow up a trading account. Confirmation bias, unconsciously seeking out information that confirms your existing belief or desired trade while ignoring contradictory evidence. Outcome fixation, judging the quality of your decisions based solely on whether an individual trade won or lost, rather than on whether you followed your process correctly. And neglecting fundamentals, even for technical traders, ignoring the bigger picture like major economic shifts or central bank policy changes, can be perilous as these forces can overwhelm technical patterns. This really raises an important question for you, the listener. Looking at this list, which of these pitfalls might you be most susceptible to based on your personality or past experiences? And what single concrete step will you proactively take starting today to guard against it?
That's a great reflective question. To support this journey of continuous learning and avoiding pitfalls, where can people turn for ongoing development? What resources do you recommend?
Continuous learning is absolutely essential in this field. The markets are always evolving. For essential books, I'd highly recommend Trading in the Zone by Mark Douglas for mastering trading psychology. It's a classic for a reason. Evidence-based technical analysis by David Aronson provides a rigorous, scientific perspective on testing market patterns, and The Disciplined Trader, also by Mark Douglas, delves deeper into developing the right mindset.
Great book recommendations. What about online?
For online resources, the TradingView platform itself has a huge community sharing ideas and scripts. Use discernment, of course. Websites like Quantopian, though its live trading is paused, its research environment is valuable for algorithmic development. Futures.io, great forums for system traders. And Baby Pips, excellent foundational education, especially for Forex, offer invaluable learning opportunities and community interaction. For data analysis tools, those wanting to dive deeper into quantitative analysis should explore Python with its powerful Pandas and NumPy libraries, the R programming language, advanced Excel capabilities, or data visualization tools like Tableau. Your learning approach should generally be: master the fundamentals first, then develop a specialization in a particular market or strategy type, continuously expand your skill set, maybe learn coding or statistics, and eventually contribute and teach what you know, as teaching is one of the best ways to solidify your own understanding.
Okay, lots of avenues for growth. And where can people actually practice all these concepts safely before going live? You emphasize demo trading, but are there other tools?
Practice is absolutely crucial, and yes, there are several excellent environments. The most accessible are broker demo accounts. Virtually all reputable brokers offer these, running platforms like MT4, MT5, CTrader, or their own proprietary platforms, funded with virtual money but using live price feeds. TradingView's paper trading feature is also excellent and integrated right into their charting. For more rigorous backtesting practice and simulating historical market conditions bar by bar, specialized replay software like Soft4FX is invaluable. There are also dedicated trading simulators available online. And of course, the backtesting platforms within tools like TradingView, MetaTrader, or dedicated software allow you to test strategy logic historically.
How do you make practice effective?
The key is effective practice guidelines. Treat your demo trading with the exact same seriousness, discipline, and emotional control as you would live trading. Follow your trading plan rigorously. Keep detailed journal records for every single demo trade. Make sure you practice across various market conditions, trending, ranging, volatile, to see how your strategy performs. And critically, focus on the quality of your process and execution, not just the virtual P&L outcomes. This dedicated practice builds the essential muscle memory for disciplined execution when real money is on the line.
So after all this preparation, the learning, the planning, the testing, the practice, what does this all mean for finally taking that big step, going live with Real Capital? How do you manage that transition successfully?
The transition from demo to live trading is a significant psychological and practical milestone, and it requires very careful discipline management to avoid early setbacks. Before you even think about funding an account, ensure you complete a thorough pre-live checklist. Has your strategy been robustly validated with a significant number of demo trades, for example, 100 plus? Do the live demo performance metrics reasonably align with your backtest expectations? Is your comprehensive trading plan finalized, printed out, and thoroughly understood? Have you carefully selected your broker based on factors like regulation, competitive costs, spreads commissions, reliable execution, and good customer support? And critically, have you allocated specific risk capital for trading money that you can genuinely afford to lose without impacting your essential finances? And is it completely separate from your personal savings or living expenses?
Checklist complete. What's the approach for actually starting live?
The recommended going live approach is cautious and gradual. Start with microsizing. Begin trading with a significantly reduced position size, perhaps only 25% or even 10% of your standard calculated risk per trade. For your example, risking 0.25% instead of 1% initially. For the first few weeks or months, your primary focus should be relentlessly on consistency in executing your process according to your plan, not on making profits immediately. Prove to yourself you can follow the rules under live fire. Only gradually scale your position size up towards your standard risk model, and do so only after demonstrating consistent, disciplined, and preferably profitable execution at the smaller size, perhaps after 20 or 30 successful trades following the plan at each incremental risk level. And maintain regular reviews, perhaps weekly for the first 3 months of live trading, then monthly thereafter, to closely monitor performance, manage emotions, and make necessary adjustments. What's fascinating and important to understand is that for most traders, becoming consistently profitable typically takes anywhere from 1 to 3 years of dedicated, disciplined effort, learning, and refinement.
It truly is a journey, a marathon of skill development, not a sprint to instant riches. Patience and persistence are key.
That's a really important dose of realism. Okay, you've just completed an intensive deep dive into transforming your approach to the markets, moving from that often unpredictable world of gut feelings and intuition to the structured, evidence-based realm of the professional trader or investor. This wasn't just theory, it's a comprehensive framework designed to give you a quantifiable, potentially sustainable edge.
So consider this final thought. If research suggests 80% of purely discretionary traders ultimately fail, and you now possess a detailed, comprehensive framework to approach the markets systematically using data and managing risk, what new possibilities and what new level of confidence might open up for your financial future when you genuinely commit to mastering and implementing this data-driven process? We really encourage you to revisit the specific areas from this deep dive that resonated most strongly with you personally. Perhaps start by defining your own SMART goals today, or maybe draft that initial trading mission statement. Or commit to setting up and diligently using that detailed trade journal, starting with your very next trade, even if it's on demo. The journey to truly informed, disciplined market participation begins with that first deliberate, data-driven step.
Until next time, keep learning, keep growing, and keep deep diving into what truly matters for your success in the market.